My pleasure to introduce James Callejas, who is Vice President of National Accounts with 1031 Exchange. And they are incidentally a Fidelity National Financial Company subsidiary separate from the Fidelity Title Company. And we're delighted to have some representatives of them sitting in today as well. So, hello, everybody.
Oh, now we're on camera?
Yes, we're on camera. So,
that was a
and if you have questions, Jeff Radovan, who's helping us here, is going to pass them along to me so I can give.
Jeff looks like he's staring at us right now.
I know. That's
He is. Or right at me.
Yeah.
All right.
All right.
Ready to
Okay.
go?
Yep, we're ready. Jeff and Rachel.
Hi, everybody.
Hello.
All right.
Okay,
James, you're
yeah,
you're
no.
up.
One thing that wasn't mentioned is I am born and raised San Francisco, so I'm one of those rare breeds. And actually, my parents' house is like 3 blocks from here, so I got
Oh
to
my
see
gosh.
it today.
Oh, neat.
Yeah, right off of Dewey Circle, so I'm very familiar with this area. I remember what this used to be before too. It was a restaurant back in the day.
Oh,
Interesting.
all of it?
Well, it's broken up, but
Okay.
this was not this.
Okay.
So, for the people that are here in the room and the people that are watching, if there's anything that was not listed on the flyer that was given out that you wanted me to cover in particular, please feel free to let me know so I do not forget to go over any of that stuff. I don't even know what the flyer was.
That's different.
That's different.
That's
Does anybody have the flyer?
It, one second. I have it right.
Because all you guys have been telling me is California Clawback, and now that's in my head.
Okay,
Among the topics are delayed exchanges, current tax rates, exchanges versus cashing out,
tax reform, California clawback, marketing the 1031 exchange, and reverse exchange.
Okay, so let's start from the beginning. The 1031 exchange is the code in real estate that allows us to sell and buy investment property. And if we do it correctly, come on down. If we do it correctly, we'll put ourselves in a position to pay 0 in capital gains tax. So anybody here in the room know why we do 1031 exchanges?
Yeah.
Yes, ma'am.
To not pay or to defer taxes, sorry.
That actually would be incorrect.
Okay.
Oh.
And you look perplexed off of that as well.
Mm-hmm.
If I don't want to pay tax, there's a very simple strategy. Anybody know what that simple strategy is if I don't want to pay taxes?
Don't sell.
Don't sell.
Yeah, never sell.
Don't sell.
Never
See, I'm never going to go to somebody out there and say, look, you need to do a 1031 exchange so you don't pay tax.
I didn't say don't pay, I said you defer. I started to say
Defer,
that.
Yeah.
defer, not pay, delay, whatever you want to call it. That's not why we do 1031 exchange. Although that's the most common answer that I've heard throughout my 20-year career. If I don't want to pay taxes, I don't sell the asset. The reason I do a 1031 exchange is because I want a different or better piece of investment property. That's it. And in San Francisco, I could think a number of different reasons why people want to do 1031 exchanges. Now, my parents, actually, here's a trivia question for you guys. My grandparents migrated here from Central America in 1937 and bought property in Bernal Heights. Anybody care to guess what a 3 and 2 1,200 square foot house on a 3,000 square foot lot would have cost on Cortlandt and Andover in 1937?
Oh, yeah.
It's on the wall.
You know what? It might be on
Seriously,
there.
might be on the wall.
5,000.
No.
5,000?
3,500.
30,000?
6,000.
6,000?
7.
7,000?
I'm going with this.
$1,700.
Oh
my
my
God.
Look at you, you were going 30,000. And they were mocked. It kind of gives you an idea of San Francisco over the years. I used to get excited about that property, but being Latino, how many other people do I have to share my inheritance with? At the end of the day, my inheritance might be $1,700. So what got me more excited is my parents bought property up the block over here and in Noe Valley in the 70s.
Mm.
Now, anybody care to guess what a 3-unit building would have cost in 1971?
In where?
No.
18.5.
Now I'll go 30.
100.
30. 30.
Then go to
How much?
30.
30, 18.5,
25,000.
25,000?
24,000.
This is right.
I'm going on.
I know.
75. It's not like.
$52,000.
See?
See, the first one was really bad. This one is right on target.
Yeah.
Now, they bought the property many years ago for almost nothing. We can all agree on this. And it's been rented out. And they probably average about $2,000 per plex. It is a free and clear property. Is this a good piece of investment property for my parents today?
Maybe.
Yeah.
Yes?
Yes and no.
Yes and no?
No.
No? Yes?
Yes.
No?
Call
Yes.
your parents'
Maybe.
option.
This is a
Yes.
horrible piece of investment property. There is no maybe about this. We own investment property for 4 different reasons. What are the 4 reasons we own investment property?
Appreciation.
Appreciation. How'd they do on that one?
Great.
They killed it.
Yeah.
They killed it. But at some point, there's so much appreciation that the return on the investment no longer makes sense. And in their scenario, what would a property like that go for today?
Depending on the income, it could go for over 2 million.
Could go for more, could go for
Yeah.
somewhere in that ballpark. The idea is that there's so much appreciation and they are subject to rent control on this property that it doesn't really make sense.
And
for them.
COPA.
COPA, when they sell that now, whatever broker is going to be trying to sell that property will have to deal with the nonprofits in that whole scenario. Although I've heard that it hasn't been that difficult so
Yeah.
far in terms of COPA from the people that I've spoken with. So the 4 reasons we own investment property. 1 was appreciation. What's another reason we own investment property?
Cash flow.
Cash flow. How's their cash flow on this property?
Probably not good.
Garbage, right?
Mhm.
They're stuck at $2,000 per plex. What could they rent that out for right now, market value? They're 3-in-1s.
Oh,
About 1,100 square feet.
yeah.
Yeah.
At least
Over $4,000.
Yeah.
So
say 5.
they're losing a lot of money on this property each month, and there's really nothing that they can do about that right now. 3rd reason we own investment property.
Cost recovery.
Tax shelter,
What's the tax shelter for investment property? called?
depreciation,
Depreciation. Is this residential or commercial property?
residential.
Right? Because it's 4 units or less, it's a 3-unit building. How long can we depreciate residential property?
27.5.
27.5 years. How long have they owned it?
More than
More.
that.
More than 27.5. So the reason why we have cash flow come in and a write-off for it is called depreciation, right? It will shelter some of the income. First off, there is no more depreciation left on this asset. Second off, on any piece of real estate that you buy, you only depreciate the original purchase price minus the value of the land. So if it was like an 80-20 split, they were really only able to depreciate $40,000 worth of this property. Divide 27.5 into that, that's not even $1,500 per year on the depreciation. So it doesn't really work for you. And there's none left. So the cash flow is stuck and it's poor. Appreciation doesn't get the return on the investment that you're looking for. Depreciation cycle is run out. 4th reason we own investment property is amortization. If the property is free and clear, how much amortization is left?
No.
0. My parents are what now?
Older than you.
That is a very nice way of putting it.
Senior citizens, is that what you're, cash poor, there's
I
a lot of.
I would have just categorized them as old.
Elderly.
Yeah, elderly.
But they're my parents and I can call them that and nobody else really should.
Yeah.
But when you're older, what are you looking for? 2 things.
Security.
That's one. And what else?
Cash flow.
And cash flow. It's real simple. What don't they have right now? They don't have good cash flow,
Cash flow.
right? Because how much are they making per month on this property? 3-unit building, $2,000 per plex.
6,000.
Not even 6,000 because that's the gross. There is a net. And with properties that were built in the early 1900s, how many issues come up with the property?
A lot.
A lot. And so now the net would probably come out about $50,000 per year. Is that a lot of income on all that equity?
Mhm.
They could sell this asset, but then who's the biggest loser if they sell that asset?
Kids.
Yeah, I am. So if you can't make that, if they sell and cash out, then I am going to miss out. And this is very common in San Francisco. So the obvious thing would be to do a 1031 exchange if they're going to sell this asset because it could change their lifestyle. Why are they doing a 1031 exchange? To get out of the asset that doesn't give them the cash flow that they deserve. And by the way, my dad is blue collar, my mom is white collar. So what does that mean with this property?
Your dad does everything.
My dad does everything. And in Noe Valley, we understand that the steps to go up are like this and that. He's one slip away from what?
The end.
Not the end. We're going morbid here. Not the end,
Well, if
but
it's right
an accident, all right? Just an accident. Although with the stairs, that property could be anybody's end. But the idea is we could accomplish so many different things with getting rid of this asset. This asset was great because of all the appreciation it amassed. It amassed a good fortune in this property. They could sell it, and instead of taking the money and losing, how much would they lose in taxes? Anybody care to guess?
27, 30%.
Yeah,
27, 30%?
capital gains, basically the capital gain.
Penn State.
Anybody else?
It was around 35, 40?
I'd go more with that number than this number. And let me explain why. We pay 4 different ways. Number one, state tax. Now, my parents are retired, but they still have pension, Social Security, and different things. But that's not going to put them into the highest bracket for federal tax. You know what's going to put them into the highest bracket? They made over $2 million on this property. So maybe a portion of it will be taxed at 15%, but the majority will be taxed at 20, well, for state tax. A portion will be at 9, 10, 11, 12, and the majority will be at 13%. Same thing for federal tax. A portion at 15%, the majority at 20%. So now we're probably over the 30s, but there still is Obamacare and that contribution, the Health Care Act, of 3.8%. So 3.8, 20%, 13.3, and any depreciation will be recaptured at 25%. We're more in that 35 to 40%. Most San Franciscans that are selling assets out here with massive appreciation, or if they have very good income, are going to go to the highest brackets. So if they were to sell the property and just take the money and cash out, you're losing 35 to 40% of every dollar. This is all gain on this property. That's a lot of money to lose.
And they don't live in a third of it, or do they?
No, they
Oh,
don't.
you said they live on Dewey.
They live right up here off of Claremont. So this is just pure investment property. Even if they live in a third of the property, and that's prevalent in San Francisco
Yeah.
quite often, they could protect only 500,000 of that one
Yeah.
unit. And the remainder is either be 1031. Anything above the exclusion amount is subject to capital gains tax. So you can only protect a certain percentage. And in San Francisco, that doesn't really cover it more often than not when you're people that have bought San Francisco property many, many years ago. So what can they buy in a 1031 exchange? They're looking for security and they're looking for cash flow. What should they buy?
Commercial.
Yeah, I would recommend some sort of commercial asset that they have no responsibility for and they get a paycheck. And I would recommend something that probably has a long lease, good tenant, corporate guarantee, full triple net, whether it be the DSTs that we could talk about or just a triple net property. But I think for them, that is an exit strategy that could work. Anybody care to guess how many investment properties there are in San Francisco percentage-wise that qualify for a 1031 exchange? Residential property?
80%.
Not 80%.
Good try, James.
70%.
No, I'd say it's more like 40 to 45% out here. There's a lot, but there's not that much. And San Francisco would probably be number one in terms of property that qualifies for a 1031 exchange. In other areas, they just don't have that component. So in the Sunset District, which I'm very familiar with, how many of those properties out there do you think have in-laws?
Most of them.
70%.
I'd say higher than 70%. I'd say it's really high. How many of those are rented?
All of them.
Most of
Some
them.
of them, yeah.
And how many of the people live upstairs and rent the other in-law unit?
A lot of them.
Right?
Yeah.
That is a primary residence exclusion and a 1031 exchange in the same transaction. How many of those transactions do we have throughout San Francisco? Or opportunities? A lot. And so that's why the real estate professional has to understand, to cater to that market, you have to understand an exit strategy for 1031 exchanges. You have to understand what it is, how to identify it, and the parameters and the rules behind the 1031 exchange. That market is so very high. Who here in this room goes after it? No one. So you guys just go after the primary residence?
Well, some of them, if they haven't put the rents, I've had issues where they don't pay taxes on the rent. It's all,
And I've had that many times. I've had people call me, James, what's the percentage? What do you mean, what's the percentage? Well, I rent out downstairs and I live upstairs. Tell me the percentage that qualifies for the 1031 exchange. And I tell them, I can't tell you the percentage. Your tax advisor needs to tell you the percentage, because that's the percentage that's being depreciated. Oh, we don't claim the income. What is that called?
Stupidity?
Fraud.
Fraud. Fraud. And now you're trying to cover up fraud with a 1031 exchange.
yeah.
So you'll get scenarios like that, and I've dealt with that many times. That really shouldn't be a 1031 exchange. That should be somebody claiming that income. There might not even be a lease agreement there either. Who knows what's going on with that property, but I deal with that quite often.
So James, you mentioned exit strategy for 1031s. Are you referring to the possibility that the family you just described are already in a 1031, or you're talking about an exit into a 1031?
I'm talking about you talking to people, whether it's in a listing appointment, whether it's at an event, when you find out that they have a property that maybe they're tired of, that they don't like, that they want better cash flow. They want an exit strategy where they could sell San Francisco and go into something that's going to improve their investment property.
Right.
So there'll either be somebody who's in the trade where you're going to help them find something, or more often you're trying to get a listing and you find somebody that's in that criteria and they want to know what's better than what they currently have. And that's usually just about the numbers. Right, for true investors. But there's a lot of different exit strategies. I've done many 1031 exchanges for people where they have an investment property, a primary residence. They're empty nesters. They've built up equity in both properties, and they come to me and say, we're done. We don't want anything. I go, what do you want to do? We want to leave California. We don't like it here any longer. San Francisco's always foggy, right? What do you want to do? I want to go to Hawaii. Well, I can make that magic happen. Here's what we're going to do. We'll sell your investment property. We'll do a 1031 exchange. We'll buy Hawaii. We'll rent out Hawaii for the first year or two. Then we'll sell San Francisco, pocket your $500,000 exclusion, and go move into Hawaii. So sometimes it's somebody trying to create a dream home, exit strategy. Sometimes it's for better cash flow. Sometimes it's for diversification. In other words, we can sell one San Francisco property, but when we go to Buffalo, New York, and want to buy condos out there, anybody here know what a condo goes for in Buffalo? I just found this out recently. That's why I brought it up.
Who cares?
You're East Coast, right?
Who wants to live in Buffalo? 10 months of winter.
30,000. These are investment properties.
Yes,
You're not living
yeah.
there.
Okay.
$30,000 a
Yeah.
condo, renting out for about $700 a month. How many condos can we buy with $2 million?
Yeah.
It's a good return.
Now, I'm not interested in doing something like that. Some clients I've interacted with, it's just the concept that I could sell one massive property out here
Yeah.
and buy a slew of different properties throughout the United States. And maybe it's for cash flow, maybe it's to get out of state tax in California. There's a number of different reasons why people do 1031 exchanges. All we have to do is have a conversation with somebody to find out what they don't like about the property. When I talk to my parents about their investment property, what don't they like about it? Rent control, dad working on the property. And those are the two things that I hear quite often, because he complains and that they're rent control and can't get more cash flow when they know that the market value rate is so much more. They're not even going into, I've already used up the depreciation, I built up all this equity. They don't even think like that. It's the things that annoy them. And then when I tell them, well, you know what, I can get you out of this, preserve all the equity, double, triple, or quadruple your income somewhere else, and dad no longer has to be a part of this. As a matter of fact, they will arrest him if he tries to work on any of these commercial properties. Because I don't know if anybody here has blue-collar parents of any kind. They're built a certain way.
Yeah.
And it's my responsibility. I have to work on it. Once you take that away from them, they don't know what to do.
So the transition you started to describe about Hawaii in that example is that they would need to retain ownership as an investment property for a minimum of 2 years.
There is no set time frame on how long. There is certain revenue procedure that supports a certain path, So this is what most people do on conversion to be safe. And there's aggressive and conservative. The conservative route would be to sell investment property, buy Hawaii or wherever you're going to buy. For the first 2 years, rent it out at least a minimum of 14 days per year, and don't use it for personal use more than 14 days per year. After that 2-year period, convert it to whatever you want. That's what the revenue procedure says. Then there's the other CPA that says, you know what? I think what we should do is we should rent it out for a full year, just get a whole year lease. And after that year, because the capital long-term investment is 1 year and 1 day, we'll convert the use of the property. Things changed. What a realtor should never do is say exactly how long it is. A realtor should say, there are strategies that you could implement in order to get the dream home that you are looking for. How long you need to keep it as investment property prior to conversion? Talk to your tax advisor. No tax advisor is going to be longer than 2 years, some years. And that is a huge strategy that I see out there. They convert their investment property to a second home in Tahoe, a primary residence somewhere else, and they just take advantage of that. Another problem that I see quite often in San Francisco is that we have massive appreciation out here. Like my parents bought a property off the block for almost nothing back in the day, and now how much is it worth in this neighborhood?
Crazy.
Crazy, right? So how much is 500,000 going to protect?
Not much.
Not much. What's the strategy? Either we keep it till we die, right? Because we swap till we drop, or buy till we die because the step up in basis happens in real estate, right? Parents bought it for 50,000, it's worth $2 million today. If they sell it, it's a big gain. If they die, this 50,000 goes up to market value. And when the beneficiaries inherit, we sell, no capital gains. So you could do that. Or you could move out of that property, rent it out for a year or two, then sell it. You've still lived in it 2 out of the last 5 years, so you can still collect the $500,000 exclusion, and you can 1031 exchange the rest. I met with the financial planner downtown San Francisco, and he comes to me, he goes, James, I got this big problem. And I go, what's your problem? He's like, I bought a property in Tiburon in the 70s for about $400,000. Today it's worth $4 million. So first of all, I said, this isn't a problem.
It's a good problem to have.
This is a unique scenario that you should really take advantage of. He says, what should I do with this? I don't want to pay anything in taxes. I go, you have another property in Sonoma. And even if you don't, just go rent somewhere for 1 to 2 years or live somewhere for a short period of time. Rent out Tiburon. Then sell Tiburon, where you still lived in it 2 out of the last 5 years. Pocket the $500,000 exclusion, 1031 exchange for $3.5 million into some commercial property. Commercial property usually gets you about a 5 to 7% cash on cash return. I'm not that great with math, but I know that 6% cash on cash return on $3.5 million equates to over $200,000 per year. So he went for no income on a property to putting $500,000 in his pocket and getting over $200,000 a year in generated income. Do those examples exist in San Francisco?
Yeah.
Oh, yeah. All the time. And when I know that over 40% of the property automatically qualifies, others could be converted. I just know that if I'm not targeting that market, I think it'd be a good idea to look at it, but I think it's all about the message. So I've owned investment property for about 16 years now. And I get about 3 postcards a week. What do the postcards say all the time?
We'll buy your property.
Want to buy your property is one of them, and the comps. What don't I like about my investment property?
The mail.
Whether I could throw that away all day long. That one doesn't bother me. As a matter of fact, I do look at the comps sometimes. Oh, somebody wants to buy my property again. But what really bothers me about the investment property?
Maintaining.
Unpredictability in San Francisco.
Tenant.
Yeah.
Part of that, mostly that.
Yeah.
Mhm.
Because over 16 years, how many 3-day notices have I put on the door?
Yeah.
How many times have I had to clean up something that was just like, you guys are animals, right?
Yeah.
How many times has there something gone wrong, right, with the maintenance or something like that? How many times have I got a message like that in the mail? Tired of the tenant, the trash, the toilets, the termites, the taxes?
Yeah.
Would you like to increase your cash flow? Have you used up your depreciation schedule? Would you like to buy a property where you no longer have those headaches? I have never once in 16 years of owning investment property received a postcard like that. If anybody on the call or anybody here is interested in that, we have a slew of marketing materials. Use them. Just email me and say, James, send me the marketing materials. It's all messages like that, where you can capture the equity and use that to your advantage, where you can get out of being a landlord and get into something that gives you the return on the investment that you want without the headaches. Because I think that's the big message. What's a big message out here in San Francisco? Obvious ones. One, get rid of rent control. Want to get out of California. Tired of dealing with tenants. And there's so many pitches, in my opinion, in San Francisco. How do we find these people?
Taxes, tax records.
People who are
Rachel and Jeff might be able to help with
Yeah.
that one. I mean,
Absentee owner.
absentee owner who've owned the property for how long? Well, first off, I'd start with the depreciation schedule, right? Anybody over 27 and a half years, it's a fully depreciated asset. And if the numbers aren't that large, then scale it down. Here's the thing about San Francisco. Once you own property in San Francisco for a number of years, what magically happens here?
They get rid of it?
No.
Oh.
The appreciation magically happens. In other areas, we can't always look at that as a guarantee. In San Francisco, for the most part, you're going to get appreciation in most scenarios. What's that? Profit. Yeah, you're going to have major profit appreciate. The cash flow is where you hurt. And a lot of our clientele sell San Francisco property and go somewhere else. And some stay in San Francisco, and that's all fine. But again, what we're trying to illustrate today is that we do a 1031 exchange to get a better piece of investment property for where we are in our lives now. Yes, deferring the taxes, not paying the taxes is huge, but that's not the reason why somebody does a 1031 exchange. They do it to unload something that no longer makes sense to get into something that makes more sense to where they are in their lives. And I think that pitch out there is a lot better than a pitch of here are the comps and I want to buy your property. I just don't hear it that often. Now, since you have it instilled in my head about the California clawback, let me explain what that means, because it was on the list. If we were to sell in San Francisco and buy in Buffalo, right? Buffalo, New York, we have left California. In 2014, Jerry Brown said, I am tired of people leaving California, going to Nevada, selling the asset. California gets paid nothing. Nevada gets paid nothing because there is no state tax, or wherever. It's usually less than here. There's not many states that pay more state tax than us. So what I'm going to do is implement the clawback. The clawback says if I leave California and buy somewhere else, it is mandatory that that owner of the new property, also the old one, has to file an informational return to the Franchise Tax Board just saying the new property has not been sold. And they have to do that every year that they own that property. And if they fail to do so, theoretically, the Franchise Tax Board is going to come after you. Now, initially, I thought they were going to come after you to pay all of the tax. From what I heard, at first, it's just a fine until you file the paperwork. But then I also heard another CPA say, no, they're going to make you pay. It's real simple. It's an informational return saying I have not sold the new property. See, we built this one up too much. It's not that exciting. But this is true that when you do leave California, here's what you do. Anybody selling in California, leaving California, ask me for the PDF on the clawback, just give it to the client. So you don't have to memorize this stuff, you just have it. As a matter of fact, just email me for a PDF on anything that we talk about today. Now, there's 3 pieces of real property that do not qualify for a 1031 exchange. What are the 3 pieces of real property that do not qualify for a 1031 exchange?
Your personal property. I mean, your personal residence.
Your primary residence.
Yeah.
Let's go back to the primary residence. Nowadays, how many people work out of their homes?
A lot of people.
A lot of people. How many of those people claim it on their taxes?
A lot of people.
I'd say about 30% of them. Because realtors all work out of their homes, and I'd say about a third actually claim it on their taxes. This is a mixed-use property. So if it's just primary, we have the 250-500. If it's primary and investment, then we have 1031 and the 250-500. 1031 is only for the percentage that I'm claiming for my business. That's one type of mixed-use property. Again, how many in-laws do we have in San Francisco? Lots. Mixed use if they are renting it and claiming the income. How many duplexes are there in San Francisco?
Lots.
Lots. How about triplexes?
A lot.
4 units, 5 units, a lot of multifamily product in San Francisco. If they live in 1 unit and they rent the others out, another mixed-use property. How many storefronts are there in San Francisco where they live upstairs?
A lot.
A lot. Another mixed-use property. See why this number gets so high when it comes to 1031 exchanges in San Francisco? Because there's a lot of mixed-use properties where they can take advantage of both section codes. And it's very important that we understand this because there's so much appreciation that they want to take advantage of it. I've had people sell property out here where they rent out rooms or do whatever with the property. They take their 500, they 1031 exchange over to something else, and they eventually move into that property. I had a guy who sold a 3-unit building in the Richmond district, and he bought a Tahoe property. They lived in 1 unit, rented out the other 2, and there was some parking thing that was also investment as well. They bought a $1.5 million piece of property in Tahoe with a little in-law. And they moved into the in-law for 2 years. And then they got rid of their tenants and moved into the big property. That 1031 came over here. They put $500,000 in their pocket. It was just a really great transaction for them. And now they live in Truckee, California. How many stories like that happen every month?
Loads.
Lots. Not just San Francisco, but San Francisco would be one of the bigger culprits. So the 3 pieces of real property that do not qualify for a 1031 exchange. We have the primary residence, but let's be careful with the primary residence because there are a lot of mixed-use properties. Second piece of real property that does not qualify for a 1031 exchange is the second home. Second homes qualify for nothing. Investment property has 1031. Primary residence has section code 121. That's the 25500. Second homes have nothing. How many people in San Francisco have second homes?
Lots.
Lots. So my parents bought property in Tahoe in the early 80s. And in the early 80s, how often did we go to Tahoe?
Maybe once a year.
Oh, no.
Yeah, once a month.
All the time, right?
A little different now.
Now it's 2020. How often does old dad drive up to Tahoe in the winter?
Never.
Never. It never happens. And in the summer, how often does it happen?
3 times.
Maybe, right? Who uses the property?
Grandkids.
You.
And
You
kids.
see, she just went past me because I'm already really old.
I'm just thinking of my own parents.
Here's the thing with kids of kids.
Yeah.
What if they're good at sports?
And they're living in that Tahoe.
No.
Oh, they don't go there.
You have
Okay.
no life,
Oh, you have
right?
no
Your
life,
life
yeah.
is the sport.
My kids weren't like that, so.
Then you were like, you got to enjoy life.
Yeah.
Now we're prisoners
Yes.
to the game,
Yeah.
right? And in a scenario like my parents, who uses the property?
Nobody.
Almost nobody, right? It's just sitting there vacant.
Mhm.
And how much money have they made on it? Lots. And it just sits. How much does it cost for Tahoe property to just sit?
Lots.
Is it,
More than a couple of grand.
are you
There's-
talking about
Deferred
now
maintenance.
or in the
Snowplow.
happening?
Well, it's the snow plow,
Yeah.
it's the roof and the deck that gets hit hard by the elements and the sun in the summer. It's the HOA, I mean, there's all kinds of different things. A couple of grand probably goes to like 5-6 grand negative because of the property.
Mhm.
Oh, wait a minute, we got to keep things on as well, because if you don't, what happens?
Pipers.
So when I was 22, I used the house, and what happened?
Uh-oh.
Turned off the water.
Uh-oh.
What do you have to do? Not only turning off the water,
Leave it
drain the
faucet.
pipe. See, East Coast knows this. I
Leave it
forgot to
faucet
drain.
dripping.
Yeah. I did into one, and there was a big surprise for the next person that came up, which wasn't even me. Things like that add up, right? And there's many examples. It doesn't have to be Tahoe. It could be many examples where people own second homes. In my opinion, it is another thing to go after in San Francisco for them to perhaps unload the second home and use that equity to go somewhere else, especially in areas like this where I'd say probably a third of the people in San Francisco County own another second home or vacation home. It qualifies for nothing. It's a very easy conversion to investment property. All you have to do is rent it out 14 days out of the year, not use it more than 14 days out of the year. Do that for 2 weeks. Now it is investment property. Third piece of real property that doesn't qualify for a 1031 exchange is the flipper. So anybody who buys, fixes, and sells does not qualify. We should buy, fix, and rent. How long should we rent?
2 years, or whatever your accountant says.
There you go. Second answer, not the first one. Whatever your accountant says, and they're either going to say 1 or 2 years. And that's probably the best strategy.
So a light bulb went off in your last
Rant?
example.
Okay.
So there are many people in this city that have a lot of appreciation in their property. So if they just made the choice of renting it out for 14 days the next 2 years and relocate to some other property, even here, that would make them eligible.
Where are they going to live?
A rental?
Okay.
Or
And
they
then-
could buy another, no, I guess if they bought another property.
No, they can't.
Well, they could
That would be
refi.
second.
They could refi to take money out, I guess, to go buy something else. But remember, they're going to have to sell this asset and 1031 exchange into something else.
Right, at the end of the,
They'll get to keep 500,000 when they sell, but they're going to have to exchange into something where they're going to have to play the rental game again, as long as their CPA says. It'll either be 1 or 2 years. But in areas like San Francisco, where we have massive appreciation, it's something that some of them consider, because they may go to you, I don't want to sell because the taxes. Well, have you considered this?
right.
And then that subject matter gets brought up, and then there's more opportunity. Because we're not trying to get everybody, we're trying to get everybody that needs it. And the more people that recognize it and contact us, the more leads that we get. Yes, ma'am.
What about the property tax? Like my dad's 87, climbing stairs because he refuses to move and pay more property taxes. It's not about.
Can't get around that. So that's one of the
Yeah.
that's one of the cons of a 1031 exchange.
Yeah.
I bought it for $50,000. It's
Yeah.
worth $2.5 million today. I'm paying property taxes. And I just asked my parents before they came here. It's just amazing that they're not even at $2,000 in property taxes
Yeah.
on a property over
Yeah.
here. If they were to sell and go somewhere else, they're paying property taxes
Yeah.
Yeah.
on the new value.
Yeah.
You're not going to get to carry that.
Yeah. My dad just can't stomach that.
But here's the thing. And my mom's a numbers person. That's the white collar. I go,
Yeah.
look, you're selling this where you're getting $48,000 a year. Now you're going to go into something that's getting you $170,000 a year. Pay the property taxes. I don't have to really know math well to know that the property taxes deducted from this 170 is still going to be a triple almost of
Yeah.
what you're getting.
Yeah.
So it's a numbers thing for someone. And you know what? Old school sometimes is hard.
It's
get that
just
message.
like your dad.
Yeah, it's hard. But again, we're not trying to convince anyone. We're just throwing out information that's correct. And some will see it and some will not. And for the people that do not, and this is going to sound kind of morbid, today you learn to go after the non-owner occupied properties. 1031 exchange is the tool that allows them to preserve the equity, and you go after dead people.
Mhm.
Because in real estate, this is the benefit. When you die, that basis gets stepped up. That is probably the best time to sell. Because our Noe Valley property, as I already call it our Noe Valley property, here's the biggest problem with that property. My parents don't really need the money, so they're cool with it, right? And dad's just dad, and he wants to work on it. He's built that way, right? We understand this. Here's the real problem with that property. When they pass away, what happens?
Well, hopefully it doesn't go into probate.
It's a trust.
Yeah.
So
that's a
when they
trust.
pass away, what happens?
The trustees sell it.
Okay.
Uh-oh. I said it again.
Here's the problem. There are 3 Callejas kids,
Yes.
right? James, Moron, Nimrod. Moron will want to move into the property. Nimrod will want to keep it because it was in the movie Sister Act. No, they never went in it, but it's right next door to St. Paul's Church, and you could see it in a frame. It's crazy stuff like that that happens with families sometimes. And that's the biggest, well,
Yeah.
I've seen some, you guys have as well. It's things like that that make no sense to me, because to me, it's like sell it. Sell this property right now. We have to deal with so many issues on this property anyway. It's worth millions. We have to step up in basis, sell the asset, cash us out. But I already know what one of them is thinking of doing. And that's just going to be a problem. And that happens. if my parents were to 1031 exchange out of this asset, increase their cash flow, get rid of dad's responsibilities, let him enjoy life a lot better because he does deal with that property, then that could change things. And in the future, it's easier to unload an asset like that or keep it because it's generating cash flow than to keep the San Francisco property that was built in the early, 1910 or whenever it was built. It's an issue sometimes.
Yeah.
People should use the 1031 exchange as an estate planning tool, right? We built up the equity, and maybe it is 3 children, right? And I go to child 1, child 2, child 3, and some people do it like this. We'll buy you a property. Where do you want a property? Give me an example, please.
Child.
Say, Sacramento.
Sacramento. So now, because we have a lot of money, we could buy you multi-unit. We probably won't get you a single-family residence, or we can go straight commercial property because you're choosing Sacramento. Because if I come in with $1 million, unless I go to Granite Bay and get like the hugest property, I'm not buying a single-family residence for you. I might buy more income-generating. Kid number 2, where do you want a property?
Palm Springs.
Palm Springs. Again, now I'm buying multi-family or more than one property, because even great properties in Palm Springs, you're probably not going to get it $1 million, right?
Mm-hmm.
And where would you like one?
New York.
Now we're getting the studio, right? Yeah. So that's,
Expensive taste.
it's a great choice. All of them are good choices. You can use the 1031 exchange as an estate planning tool. And I've seen people do that, whether it's for cash flow, whether it's for the children to eventually inherit, so there is no fight. The problem, what I see sometimes, is when the children inherit and they have to make a decision together. Or just make sure that the parents have language within the trust that says the property must be liquidated upon a certain time frame after death. Then everybody gets cashed out and there's no fight. Okay, so those are the 3 properties that don't qualify for a 1031 exchange: primary residence, second home, and flipper. Everything else qualifies for a 1031 exchange. So let's just say we market to people out here. We get the list. Yes.
I'm sorry, I feel like I'm living your life. So, so you convince, okay, not convince, but you're saying as a strategy with the siblings, you find out where do they want to go. This is before death.
Has to be.
Yes, and before your parents die, and then where do you want this property? And then you...
Theoretically, they could sell San Francisco right now after talking to children, and we're going to plan out where we're going to buy replacement property, so there'll be no fights. You guys will all get what you want, and there's no worries.
But you'd sell it now.
You 1031 exchange it now.
Yeah.
Go into these areas. Parents would get the luxury of those properties while they're alive. Children would inherit when they pass. Right? It happens sometimes.
Yep.
They're able to make that decision.
Right.
Congratulations.
You get New York, you get Palm Springs, you get Sacramento.
Maybe I get nothing.
You're getting cash flow, and you're getting where you guys want either a second home or a primary. Sometimes that's a good thing for family members. When they get along, I'm really shocked. It just doesn't happen as often as I'd like to see.
Yeah.
But when you're talking money and real estate, sometimes it just doesn't work. They don't see things the same quite often. So let's say we put the message out there. We get the list. When do we set up the 1031 exchange?
Right away.
Right away meaning?
Right away and send you information.
So once the offer, okay, because we can't set up a 1031 exchange prior to offer accepted. I recommend that you contact me prior to, so I can go over what you want to do just to make sure everything is good and talk with whomever. There's no cost for this either. This is just pre-planning the sale of this asset, but we can't open up the 1031 exchange until there is a signed contract. Here is the reason why. The seller is no longer the seller. We as the exchange company are the seller, because if the seller touches money, it's taxable. So what happens is we get a copy of the sales contract so we can assign it to the rights and become the seller. We also get a copy of the preliminary title report in order to set up a 1031 exchange, not because we care about liens or that much on the legal description. It's just the best deal. Whoever sells needs to buy. Seems simple. Sometimes it is. Sometimes it isn't. So I bought my first piece of real estate in San Lorenzo, California. Anybody know where that is? Yeah.
It's near San
Very
Leandro.
nearby the.
It's connected.
Correct, right? Yeah.
It's connected, yeah. It's funny, I went to Santa Rosa, not one person knew where San Lorenzo was. And I go, that's all right, how about Castro Valley? This was like a crowd of 20. They go, one person knew. And I'm like, okay, how about Hayward? And like I had 3. San Leandro, I had like 4. I'm like, how about Oakland? Everybody's like, yeah, I know Oakland. It's Oakland, San Leandro, San Lorenzo, Hayward, Castro Valley on the top, and then you get to Union City, Fremont, and Newark, and all that stuff. But the point is, I bought the first property for about $200,000. It was my primary residence. And then I moved somewhere else, and it's been a rental since 2004, I believe. Now it's worth a lot, and I could never imagine this in that area. It's just the Bay Area, and that's what happens. I bought it when I was what?
30.
I don't know.
Why you're single?
Yes.
Ah. Keeping on your toes.
I bought it when I was single, and then I got
Married.
okay, I don't even want to look at that. When I was married, then I got kids. Then I got married, and I never did what? My wife on title. Now I sell it as investment property, doing a 1031 exchange, selling it for $700,000.
Mhm.
Looking to do a 1031 exchange and looking to buy something for $800,000. Sell as James, buy as James and Angie. Did I buy of equal or greater value?
Yes.
No.
Oh,
Why?
James sold for 700. Now James bought for 400
Mm.
because he bought with James and Angie.
oh.
How do we fix this?
Don't put her
Get
on the
divorced.
title.
Get divorced. Okay, look. Hold on. These are the same answers, right? Get divorced. Don't put her on title, because the don't put her on title lands a divorce,
yeah.
right? Okay.
Can you add her on later?
And I guess you know about that. Only because she said that. Can I add her later? Okay, look, okay, I want to keep my marriage intact. Fortunately enough, I know 1031 and a simple solution in my scenario. We've been filing jointly since we've been married. I will quit claim her on title to reflect current tax reporting, sell as James and Angie, buy as James and Angie, and that would work because now we sold for 7, bought for 8. I could also buy as just James and add her on later. If I do keep this the way it currently is, James to James and Angie, there could be an issue because it looks like I'm only buying half of this.
What if you just put that in a trust and she's.
I'd have to change something
Yeah, okay,
prior to.
okay.
And I can't just say, oh yeah, just change it. If tax reporting doesn't reflect that,
Okay.
I can't just change it.
Okay.
So if people truly keep things separate, then we're gonna have a conversation over here where, babe, you are not going on title with me, and this is the reason why. We'll pay taxes on $300,000. And hopefully that works, or I'll land in divorce. Potentially. I bring this up because whoever sells has to buy. That's an easy example that you're gonna see quite often. But what about when it's in an LLC, in a partnership, in a trust? Now there's 2 types of trust, right? There's the living revocable trust, and for tax purposes, that's see-through, right? In my trust, we go off of my social security number because I'm still alive. But when I pass away, then this trust becomes irrevocable, meaning it can't be changed. And now it's under a tax ID number, meaning trust needs to do the trade. Here's how a trust becomes irrevocable in a scenario that will blow the exchange. My parents pass away, correct? It becomes irrevocable. All 3 children inherit in one trust, one tax ID number. We sell this property and are doing a 1031 exchange. Who can do the 1031 exchange?
All 3.
All 3.
Only one. Who's the one?
Your father.
He's dead. He can't do the trade, nor does he need it.
The spouse, just the
The
remaining.
trust.
Oh,
Only the trust can do it. The trust is comprised of 3 children. In other words, they have to stick together.
oh,
What are the odds of that happening?
never.
See, when we inherit this, not never. God, she's so pessimistic.
My dad was an insurance man, so.
So when, this is what normally happens. This is why we learn to sell when you die, right? If you just sell right away, there's no gain. It's fine. You take the money and good. But and this happens quite often in San Francisco, they inherit and it's 20 years later, and now the children are ready to sell the asset. It's still in the trust. 20 years ago, how cool were the siblings with each other?
Wonderful.
Wonderful, right? And what happened over the next 20 years? 3 became what?
Hate each other.
6. Well, first off, I guess in your family, they hated each other. And then in yours, it became 6. In most scenarios, it's both, right? Somebody doesn't like each other, and now they all got married. So it's not 3 voices anymore. It's 6. And the likelihood of us all agreeing with this one trust becomes an issue. So just remember, whoever is selling has to buy. And it's the taxpayer that is selling. In an LLC, for residential property, you won't see that often, but commercial property, you'll see that almost all the time. In an LLC, there could be multiple members, one tax ID number, now we got an issue. If I'm in the mix early enough, I could probably help them solve this. If I'm not, it will not work well for them. They'll be at risk with their trade. Everybody understand this? Yes, sir.
If that property was mom and dad's primary residence, they passed away, goes to the trust, can you still 1031 it?
You don't need to. It wouldn't qualify either.
Oh, okay.
So what happened, and this would happen in similar scenarios, mom and dad pass away, children inherit however many children there are. They don't want to sell it because they have an emotional attachment, but they start renting it or something. Now when they eventually sell it, if there's appreciation, then they 1031 exchange it. If mom and dad just pass away, remember, anytime you pass away, the basis should be stepped up to current value. And then you sell the asset. You don't need to do anything unless you're worth $1 gazillion. Well, it's actually $22.4 million is the threshold, and then you just pay estate tax over that.
Okay.
Yes.
Question. So it becomes irrevocable when both
Yes.
spouses die.
Correct.
So if one of your parents
So
dies.
if one of the parents dies, then they should still probably get a full step up, and that might be the opportunity for surviving spouse to sell without a capital gain issue. And as long as you don't do things like the Menendez brothers. That's a joke, I know. Jesus, those are brothers too. In my opinion, you want to strategize ahead of time so that the estate planning looks best for your children, because we never know how they're going to react. Sometimes, depending upon who your children are, you might have to help them make that decision, especially if they don't see things eye to eye.
I have another question.
I'm shocked. This is only like number 13.
So let's say your parents set up a trust and they put the 3 siblings for 45% and the 7 grandchildren as another 35%.
It's just a mess, what you're describing right now.
Yeah.
Unless they sell that asset upon death, then you have 10 voices.
Exactly. But then how come my attorney said that making it an LLC would make it worse? Any ideas there? Or?
I'd have to know more about the
Okay.
scenario. LLC provides protection. I'm assuming that's what they were looking for. I always think that when you pass away, that's probably the best time to sell the asset, unless there's something special about it. And sometimes that happens. But the step up in base is so huge to take advantage of it while it's still here, because you never know what can happen, right? They can always take things away. But that's what I would do, especially in California. The Midwest, they don't even think about this stuff because they don't have this type of appreciation.
Yeah.
Out here, this is huge. So let's go through an example really quickly because we've been here for a while so we all can understand this. So we set up the 1031 exchange. It has to be done prior to the close of escrow. We are extremely busy. This couldn't be a better timing for me to be here because the 1031 market has not slowed down. As a matter of fact, this January already looks better than last January, and last year is better than the year prior. We've just been going up in terms of activity. I get 50 to 100 emails, calls per day. I get about 7 calls per week where someone wants to do a 1031 exchange. I know, right?
I love the message all the time.
See how he throws me under the bus on camera too.
Right.
But here's the sad news about that. I get about 7 calls per week after the close of escrow. Who's at fault there?
Real estate agents.
Yeah, in my opinion, you guys know if it's investment property or not. And if it's kind of like, I'm not sure, as the kids would say, sketch, ask me and I will talk to them to make sure. But in most scenarios, you're going to know if it's investment property or not, correct? Sure. That's where you bring up the question. Were you looking to do a 1031 exchange? What's that? I have somebody on my team that will talk to you about that. That's the best segue on that. And I talk more people out of 1031 exchanges than doing 1031 exchanges. Just because if they don't need it, I don't want it. But in a regular transaction, we get the listing, it goes to the contract, you send me the prelim, you send me the contract, we set up the exchange prior to the close of escrow. At the close of escrow, we sell this asset for $2 million. Let's say there's $1 million of debt. The debt gets paid off at the close. Let's not even look at closing costs. And $1 million goes into the 1031 exchange account. And then the clock starts ticking. How many days do we have to identify? Calendar or business days?
Calendar.
So when day 45 lands on Sunday, when do we identify?
Friday.
Friday's okay, but what did you just do?
You lost 2 days.
You lost 2 days. Well, because they could still identify on Saturday or Sunday. Now, for the person that says Monday, and there's always somebody, they just didn't say it today, you blow the exchange. Calendar days mean every day. There's nothing wrong with Friday as an answer, but you also have Saturday and Sunday. Day 45 is day 45. You have to identify to us in writing the exact property address that you're looking to acquire.
So even your office close is okay?
That's fine. Yeah.
Okay.
We do everything DocuSign now. You can do
45
everything.
days cannot indicate it for 3 properties.
If you can't identify anything within the 45-day period, come day 46, you are now known as a taxpayer.
Oh, wow.
We will send back the money, minus the California state withholding, and that's it.
So you're almost better off to get into a contract by the 45th.
Here is the plan.
Yeah.
I do not list this property without an exit strategy in mind. And I want a plan A, a plan B, and a plan C.
Yeah.
And ideally, I'm in contract to the replacement property prior to the close of escrow of the relinquished property. Now, I know that gets scary. I want to be past contingencies, and I really want to make sure that this is going to happen. But ideally, if I can go contingent upon the sale, or if I can be in contract so that the relinquished property closes and the replacement property closes shortly afterwards, if I close within the 45-day period, what's the risk? There is none. Once I go past day 45, now I'm at risk.
Yeah.
How many days do I have to close?
180.
180.
180 after day 45 or 180 total?
That's in
It's included, so it's concurrent. So first 45 to identify to us in writing, next 135 to close. 135 and 45. Now, this one's really important. How many properties can I identify in the 1031 exchange?
3.
I hear 3. But what if I'm going to Buffalo? Remember?
Oh, you can buy as many.
Is it
As long
200%?
as
What's,
So there's 3 rules. The most common rule is the 3 property rule, which says within the 45-day period, I can identify up to 3 properties of any value. There's no limit, right? It could be $1 billion. It does not matter. I can do that. But if I'm looking to sell in San Francisco and buy those $30,000 condos in Buffalo, what's 3 properties going to do for me? Nothing. So then I will go to the 200% rule. The 200% rule is, what did I sell the property for? $2 million. That's my gross sales price. Multiply that times 2 to give me 200%. I can identify $4 million worth of real estate. How many $30,000 condos is that?
That's quite a few.
Yeah. So to me, from the beginning, what's your strategy? Are you looking to go out of state and buy a lot of smaller properties? We're probably going 200%. Are you looking to buy the one big commercial property? You're probably going 3 property rule. Once I find out what they want to do, then I'll be able to put them into a category. The 3rd rule is the 95% exception. In my 20-year career, I've done over 52,000 exchanges. I've seen this rule work about 9 times. It says you can identify as many as you want, regardless of market value, but you need to close on 95% of the market value that you identify. Here's the example, true story. Client sold in the city for $3 million. Identified 10 properties. What rule no longer qualifies?
3 properties.
3 property rule, right? Because 10 is greater than 3. Each property was worth $1 million. What rule no longer qualifies? 200%, because 10 million is greater than 6 million. 6 million is 200% of 3 million. Client closed on 9 of 10 properties. What happened to his exchange?
he blew it.
He blew it
Yeah.
because he needed to get to $9.5 million in order for it to work. And in this true story, same seller for every property. They fought on number 9, and the seller said, No. On number 10. Louis Whole Exchange had to pay about $1 million in taxes.
Go back. I couldn't understand what if you indicate, for example, 3 of those, but later on you find out and that 3 is not the right.
So using the 95% exception, I would never recommend this unless you have a conversation with me, because you have to close on 95% of the market value that you identify. And if you don't, it blows the entire exchange. On the 3 property rule, you don't have to do that. You can close on one of them and you're done. Same thing with the 200% rule. You just want to hit your numbers. The 95% rule, you'll blow your exchange if you do not close on 95% of the market value that you identify. I do not recommend this rule in almost any circumstance, but if it comes 8 in 52,000 times, I will let you know. If you close within 45-day period, the 45-day period, one of the rules is going to work. I'm talking about after day 45.
Mm-hmm.
Everybody get that? You have to buy like-kind property. You're going to hear that a lot out there.
Can we just give it like a real example? Like,
Yeah, what's the example?
We sold for 700,000
Okay.
and buy for indicated for 3 properties like 1 million, 1 million, 1 million,
Okay.
and then.
Did you close on one of those in this example?
If one of the property is 45 days current, cannot close, right? So
Yeah.
it will be after 45 days.
But those are, all 3 are identified within the 45-day period, correct?
Yes, that's right.
You can close on any of the 3 within the 180-day period.
Yes, but what happened if that 3 of those is not gonna close?
What day are we on?
So it's after the 45 days.
Then
So then
There's nothing that can be done.
nothing can be done.
Nothing.
So you after 45 days, say, hey, I find the other ones like maybe.
You know how many times that somebody has called me and said that to me?
Yeah.
Yeah, million.
Here's my story on
2,000
that.
times.
So I got the call, this was about 6 years ago, and the guy goes, hey, James, how you doing? I was like, this is already starting weird. Having a good day? And it was getting more and more into how I'm doing. He goes, I need to talk to you. I go, okay, well, what's up? No, I need to talk to you in person.
Mhm.
And I'm like, okay. And this guy he sold a hotel for $30 million and was doing an exchange on that. And he goes, I want you to meet me at the other hotel that I'm going to be doing another 1031 exchange on. And I think this one's valued at about $50 million. So I'm excited about that. But when somebody wants to meet me in person, I'm not a celebrity. So I'm like, worried.
Mhm.
And I get to the hotel and he goes, what do you want? Anything you want on the menu. And I'm like, there's, and he's all, the first thing he said to me after we sat down and the pleasantries were over, he's like, how do you feel about the 45-day rule?
Mm.
And I'm like, I don't have any feelings on the 45-day rule. He's all, and then after that, he goes, what's it going to take in order for me to submit another property? Because they were like on day 100. Then I had to think about it. What will it take? I mean, I'd have to have enough money to leave the country. I told him I couldn't help him in any way. So to your example, many times there's been properties that have been identified for whatever reason they cannot close on. After day 45, nothing can be done. If the guy that was going to give me millions can't get it done, all the other people aren't going to get it done either, unfortunately. Now, there are accommodating accommodators out there. I would be very wary of doing any business with them for a number of reasons I'm not even going to get into. So on like-kind property, I want you all to understand this. We're selling a single-family home in San Francisco that's a rental. It's investment property, qualifies. What can I buy? Can I buy this office building?
Yes, any income properties.
Can I buy bare land?
Yes.
A parking lot?
Yes.
Yes.
Mhm.
Can I buy a REIT?
No.
I said,
you
Why
could.
not?
what is REIT? What is
Real estate investment trust. So a REIT is a security.
Oh, that's-
It's a number of large commercial institutional properties, like a mutual fund of real estate. Does it qualify?
Yes.
In certain.
No.
Maybe.
No.
So if you have the client that wants to get into a REIT does not qualify because it's security. However, there is an UPREIT. So if you sell the single family home and buy into a TIC, which is a tenancy in common in a large commercial institutional property, that TIC is on a timetable to get absorbed by the REIT. Morgan Stanley in San Francisco does this. This is probably not an exit strategy any of your clients will use, but if they are insistent upon getting into a REIT, not a REIT they can choose, only the REITs that are set up in this program, have them talk to me. Only if they mention a REIT. Don't just start saying, hey, James said you can get into REITs. If they bring it up, I'm more than happy to speak with them about that. Can you buy a primary residence in a 1031 exchange?
No.
Yes.
Not initially.
But you still buy it, right? We'll
Yeah.
rent it first, then we'll move into it. Can I buy a primary residence and move into it day one?
No.
Maybe, right? We sell a property out here for $700,000. I want to go buy something in Healdsburg, right? I'll buy a vineyard that has a primary residence, and as long as the vineyard is equal to 700,000, then I will move into the primary residence day one. And I've had many clients that have done things exactly like that. Can I buy a primary residence and only a primary residence and move into it day one? No. That you'll rent out first and then convert after, as long as your CPA says. Can I buy oil and mineral rights in a 1031 exchange?
No.
Yes.
That goes with the deed, right?
Yes, it's considered real property, and as a matter of fact, oil will probably get a 13% cash on cash return. I'm not comfortable with it, but it is an exit strategy that you can use. I'm not comfortable with it, just I'm not used to it. Yes, sir.
Parents sold the 1031 exchange and for example 700, and after that we'll buy together with the daughter.
Okay.
And for 1 million.
Okay.
So and then daughter will live there and pay the rent. Is that all right?
Okay. Selling for 700,000, parents buy $1 million property with daughter. This is allowed. They will own it as tenants in common. What percentage do the parents have to own?
70%.
To pay no tax, they want to own 70-30 as a tenant in common situation. If the daughter's going to get a loan, get the lender involved ahead of time. Some lenders have issues with this or not. There should be a lease in place that the daughter pays the parents, and it should be 70% of the market value, could be low market value of that property.
70%.
70%, not 100 because she owns 30. She's not paying herself, but just the 70%. There's ways to do things. Just remember on like kind, if there's any questions on it, first off, don't say like kind to your clients because I think it confuses them. When you say like kind, oh, you sell the single family home that's a rental, you got to buy some like kind property. They're going to think single family. They think identical. It's not. It's residential investment property. Any commercial property anywhere in the United States qualifies. So it's a lot of different things, and 180 days to close this transaction. Now, the last thing I wanted to bring up today, and I'll take any questions you have, in San Francisco in particular, I have clients that like to buy property in San Francisco, maybe selling somewhere else, or maybe selling in the city and buying in the city. The problem is, if I say I want to go buy something in a particular area, and it has to look a certain way or have certain numbers, what's the likelihood of me finding that within 45 days? Not good.
Yeah.
So what they do in some scenarios is they do the reverse exchange. The reverse exchange is where you buy first and sell second. Now, people quite often ask me, why doesn't everybody just buy first and sell second? Well, the problem with the reverse exchange is you have to have the money to buy first. And most people are taking the money from the sale to buy this asset. So in a reverse exchange, client goes to buy property first. Here are the problems with the reverse exchange. If they are buying all cash, very easy, right? Because here's how it would work. Go into contract to buy the property. The exchange company assigns into the rights of the contract. The exchange company sets up an LLC. The LLC will go on title at the close of escrow, and then they have 180 days to sell their property. And as long as they can make it happen within that time frame, great. If it's all cash, no problem. What about if there's a loan? On residential property, how many conventional lenders will lend to an LLC? Not many. First Republic has done it for special clients. How many of your clients are special clients? Not many. I know this because I've had the test out there. It's not just go call First Republic and they're going to do it. It's usually a certain dollar amount and a relationship they have with the bank. So if they can't go conventional, then they go private. Don't worry about the interest rate. You're selling this property quickly, but the origination fees and the points that they would charge on something like that, the fees start to go up significantly in a reverse exchange. Now, if your tax consequence is huge and your client has money, they don't care. But the whole thing for a reverse exchange that's difficult is how am I going to buy this if I have not sold this? If I have the cash, and I'd say a lot of my clients in San Francisco do have the cash, we could do this. If I have to get a loan, I need to talk to the lender to see what everything that needs to be done can be done. If the seller's willing to carry back, that would be great, but most sellers don't carry back in a scenario like this, but I have seen that happen.
Is
Yes.
it cost charge a lot more?
So on a regular exchange, right? $850 on the sale, $250 on the purchase, $250 for every additional property. On a residential property reverse exchange, about $6,000. That's our fee. Lender will have their own fees. That could go up significantly higher. LLC goes on title at the close. Then client can either take over the LLC or client could go in the entity's name that was sold. One transfer tax to the LLC could be an additional transfer tax to this entity. So maybe dual transfer tax. Title and escrow fees will probably be very small to be in a binder, so I wouldn't worry about that. But lender fees and dual transfer tax, our fee is just $6,000. In the scheme of things, for property out here, that's really not that much.
Can I ask other questions
Yeah.
now? So
Yeah.
for 1031 exchange, if my client, which happened, did a exchange and really hated the properties
That
and want to
happens.
sell it less than a year,
I
what
would
type
not.
of consequences?
Why do they really hate the property?
They regret to buy the property, maybe they didn't like it.
Okay, that's not a good reason.
No, it was very problem. Like I listed and sold property in San Francisco, bought one in Oakland Hill, and it's a new development, but it was on fire. So my client couldn't sue the developer because he just
This is different. This is an extenuating hardship circumstance. That is different. See, this not liking, that's not gonna, that's not gonna cut it. But when you have some sort of that's why I ask every single time.
thank you.
And right from the start, I'm gonna say, well, you have a case, you don't have a case. I can't make the decision for you. Your tax advisor does. But from the start, I'm gonna tell you if you have leverage or not and how to talk to your tax advisor. In that scenario, yeah, we sold in San Francisco, we bought in the Oakland Hills, and then look what happened. And now we need to sell again and do a trade somewhere else. And we don't want to wait 1 to 2 years. We want to unload the asset right now. And if we have something like this, oh, hey, you know what? It's a month. I don't like it. If it was 3 months and I didn't like it because I couldn't get a renter, that's more of a reason, right? Unless you're asking for ridiculous rent. There has to be some sort of a hardship reason that allows you to do it that quickly. And you have to have the tax advisor on board, because in an audit, you're not protecting, I'm not protecting, tax advisor protects.
Okay, so it's possible
Yeah, it is possible with your
to
scenario.
do another exchange
Oh,
because
yeah.
he already closed escrow.
Yeah.
Okay.
You have an extenuating circumstance.
Okay.
I hear fire, I'm already thinking like,
Yeah.
yeah, this is not good.
No.
And there's a reason. So if you're in an audit, you say, yeah, this was the plan. But look what happened.
They have the hydraulic heating system and didn't install right, so it was on fire. And tenants there, it was just a mess.
This sounds like hardship, right? We all
It
agree.
is totally hardship.
So if you're audited, these are the reasons why. And that's why I feel comfortable. When you have a reason like this, and I get this reason a lot, we don't like it. We didn't, for whatever the reason is. And that happens as well, but I don't recommend it. I say, okay, we'll just stick it out for a little bit longer to be safe, and something like that.
Okay, thank you.
Any other questions on any other subject matter? There's a lot of things. One more thing I did want to mention, because I get the question all the time. A lot of people like to do a 1031 exchange and save some of the money for improvements on the property they're going to buy. Can you do this?
No.
Yes, you can. There's 2 ways to do this. Number one, improvements never qualify as real property. So one way to do it, and this one's more difficult, is to have the seller do the improvements, which would increase the sales price, and they must be completed prior to the close of escrow. I think for minor improvements, this might work if you could send some non-refundable deposit money over. I've seen it happen, but not that often, especially for a big job. That's not going to happen. The second way is called a build-to-suit exchange. A build-to-suit exchange is where, like a reverse exchange, we set up an LLC as the exchange company. We go on title at the close. While we're on title, the improvements happen. The problem with that exchange, you have 180 days to get that done. In the city, can we ever get anything done? In other areas, yeah, I know. Well, if you are in the business, you might be able to get it done and might be able to push things along. But Improvements can be done, but there's a limited time frame to get them done. If your client has questions on that, please let me talk to them. Because I get this question about once or twice a day. I wanted to save about $100,000 for the improvements that we need to do on the property we're looking to buy. And then I start answering those questions and see if it's something that they can or can't do.
James, you mentioned earlier DST. And
The Delaware Statutory Trust is an investment that a lot of our clients that are elderly, that are no longer looking to manage properties, get into. And basically you are putting the sale asset, those proceeds, into a DST, which is a large commercial institutional property, more often than not, huge multifamily product, Class A building that they're going to hold for about 5 to 7 years. It gets about a 5 to 7 cash on cash return. You do no management responsibility. The broker dealer deals with everything. I think that is a strategy that you should be familiar with for the client that wants that kind of exit strategy. They aren't going to list unless they have something that has the security and the income that they're looking for. Nothing is guaranteed in real estate. We all know this. But I think in these multifamily, they're like $80 million apartment complexes, like 400 units plus in areas that are looking to have significant growth. And at the end of the day, they project about 10 to 15% return on the asset. And they usually sell them within 5 to 7 years because they have 10-year commercial loans on them. I think they are good investments for the right client.
And there's a 45 days.
Same thing. But they always have product available.
Right.
So maybe as a backup, you could always have a DST. You will never fail an exchange if you're looking to get into a DST.
Oh, that's interesting.
Would that be your third choice, or you do your 3 properties and then a DST?
Some people, it's their first choice. Some people, it's a backup choice.
Okay.
So it just depends on what the client's looking to do. I think it is a great investment strategy for that client.
Are there dealers in those here?
Yes. You won't find product here because the numbers just don't work in the Bay Area. But yeah, there are people I would refer you to in San Francisco that you could meet that I trust, that will tell you pros and cons. The exit strategy is the biggest con with the DST. You are in this and there is no true secondary market. So you're there for 5 to 7 years until they sell that. Either you go into another DST or you go into a different product. But I think it is a great investment for that client.
If they can live with just income stream and not require the capital.
Well, they'll get some capital. They'll get appreciation on the asset as well.
Right, I mean, they can't draw the capital.
No, they can't. So they've tried to fit some of that element into it, but no.
Yeah.
That is just a true passive type of investment. But the risk level, I mean, I think multifamily has the least amount of risk, to be honest, of any of the asset classes out there because everybody needs a place to live.
Sure.
And when you're going Class A, you're going property that doesn't need maintenance. So those properties are usually built in less than, within the last 10 years.
So those are the commercials we hear on the radio.
Right.
Maybe they might be
Serious
pitching.
XM.
They might be pitching other single tenant lease properties.
Prime properties.
They were
in
then
Hoboken.
specifically saying Class A.
Yeah.
Is there a
Back to cash
minimum?
flow. Yeah.
No, not really. I think the minimum might be like 50 grand or something, like 25 to 50
I
grand.
heard a lot of people put their boot. To the-
Yeah, a lot of people put a boot. If you don't know what that is, it's money that isn't used towards the replacement property. You have to buy of equal or greater, use all the cash. Yeah, I mean, I've had people that sold, $30 million properties in San Francisco, and they go, we have $700,000 left. What can we do? They put it into a DST.
Mhm.
And, some people just get lucky in the DST because it's in a certain area, appreciates significantly. So not only do they have a stream of cash flow, but they made like another $400,000 in appreciation.
How do you get out of it again? So you have a term?
You get out when the sponsor says you're going to get out, and it's going to be about 5 to 7 years. They have a 10-year commercial loan. They're not going to stay in it that long. So they've started preparing to get rid of it within that time frame. They have projections to hit a certain number.
Is that part of the agreement that you will be out within 7 years?
I've never read through the agreement, but that's exactly what they say up front.
Okay.
That is like the time frames that you look to get out. They're not looking to get out year 8 and 9 because the loan's about to mature. They're looking to get out within this specific time frame. And they could get out sooner if something crazy happens. Not bad crazy, but good crazy. Like somebody wants to buy it for a ridiculous amount. everybody's going to be on board to get out of it because you just made massive appreciation. Put us into the next one that's going to do that. Well, you're not going to get the next one that's going to do that. You got this one, you're lucky. The next one probably just going to be constant cash flow.
James, we had a question sent on beforehand. Is a DST the same as a Delaware Trust Exchange? First question.
The Delaware Statutory Trust is completely different than the Deferred Sales Trust. The Deferred Sales Trust is a different exit strategy. The Delaware Statutory Trust is something that you would use as replacement property in a 1031 exchange. The Deferred Sales Trust is not.
Okay, got it. This same agent was also curious to know your thoughts on monetized installment sales.
We do not support monetized installment sales because of the companies that are providing that opportunity. If they go belly up, then so does your investment. We used to support one that did that about 4 or 5 years ago with that type of platform. But then when Allstate pulled out, so did we.
Understood.
I don't know them well enough to really give more information on that, but that's what our legal counsel has said.
Any other questions?
Do you have a particular attorney or group you recommend to handle those? Either the Delaware Trust Exchange or the monetized installment?
I do for the Delaware Statutory Trust in San Francisco. And if anybody here or that's watching needs a real estate attorney, I teach at all the law firms in San Francisco for the most part, and I'm happy to recommend if you need it at that level. I'd go to me first because I'm free. Mm-hmm. Attorneys in San Francisco, even the juniors, are going to be over $450 an hour. Yeah, easy.
Okay.
Did you have a question?
No, I'm fine. Can I ask you for the document and I will send you email?
Sure.
For the
Absolutely.
PDF also.
Mm-hmm.
Yeah. Anybody here that wants any PDFs, just email me for them on anything that we spoke about, whether it's DSTs, whether it's second homes, whether it's holding title, whatever. Everything we spoke about or anything you can think about, I probably have it. Build a suit, reverse, anything. I have PDFs on almost everything.
I mean, one of the things I will say that was wonderful about today was changing a mindset to realize the real opportunity for marketing these products as an agent.
Agents don't think of it that way.
They
I
think of it
talk
as
to
a
them all the
reaction.
time. They're like, oh, that's something I got when I didn't try to get it. It just happened.
Yeah.
Not I actively went after it.
Yeah.
And when they do actively go after, I go, what message are you giving? Well, I'm saying this. I'm like, well, as an owner of investment property, it doesn't really preach to the problems or what makes me want to sell my property.
Yeah, too frequently it's an agent will mention to me as the manager, I've got somebody that's doing a 1031 exchange. Can we talk about that? Okay. So it's a lot of that. And as opposed to taking advantage of it, I think this is a potentially great business model.
I have so many realtors that just call me, this is my first one. I don't really know what I'm doing. I've never done one of these before. How confusing. It's not confusing at all.
No,
We're going to get something sold and bought very quickly. We're going to find out what they want. We're going to try to execute this. We know our target price. We know how much projected cash we're getting. That's it. And then I have the regular residential realtors that do these all the time, and they just kill it because the investor friends, the investors they have hang with investor friends.
Right.
And that's how you get referral business for that type of product. And in San Francisco, oh my God, there's just so much investment property. No worries. Thank you.
Okay.
I think we're good.
Yes, thank you very
Thank
much,
you,
James.
Any fidelity message you guys want to say? Open up escrow?
Yeah, exactly.
Yes.
Thank you to the Fidelity family of companies for being here today.
Thank you.
Wonderful. Thank you.